Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Anderson, and Tom is a director, founder, and past president and CEO of Pensco Trust, which is a bank and trust company, it handles self-directed retirement accounts. Tom is currently the president of the Retirement Industry Trust Association, or RITA for short, and it's a trade association for non-bank custodians, or I guess custodians in general, of IRA and Roth accounts. So Tom pointed out Pensco started as a non-bank custodian and then converted to be a bank at a later time. He grew up in New York, and in 1969, Tom started working at Hartford National Bank, where he became the head of systems development and strategic planning. In 1981, he came to Bank of America in California, where he became head of trust systems development and trust and stock transfer data processing. And then in 1989, he co-founded Pensco Trust. Tom has testified to the Department of Labor and the IRS about IRAs, instigating changes to the IRS regulations governing IRAs, specifically relating to the capital requirements for any company offering IRA services. He was invited to Washington, D.C. in March 2009 to participate in an elite group called the Future Finance Initiative to make recommendations about improving the economic condition of the United States after the market crash back in 2008. Today, Tom and I are going to be talking about alternative investments besides real estate in your IRA or Roth account. We have another interview where we discussed investing in real estate in your account. You can see that interview under past episodes at financialinsiderweekly.com. Related to this, I have written a book called How to Use Roth and IRA Accounts to Provide a Secure Retirement. Tom is going to be referring to some other books that you might want to take a look at. What I'm trying to get at, though, is that this is a complex area. There are books about this that are a lot thicker even than the books that he and I are referring to today. This is a starting point for a bigger discussion, and we want you to get qualified legal and tax advice. This is probably, I think this is a team project. It's not a do-it-yourself project at all. So Tom, thanks for joining me today.
Certainly.
Okay.
My pleasure.
Okay. So maybe you could tell us a little bit about, again, how you got into this area of offering independent trust services for IRAs.
Well, my entire background started, as you mentioned, at Hartford National Bank. I started as a programmer developing primarily trust and stock transfer systems, and so I was intimately aware of the various kinds of investments that are typically involved in self-directed IRAs back as far as 1969. And then I worked in the trust department at B of A, and then when I left, I was involved in my own consulting company to other banks, and I got a job helping a firm which happened to be down in Milpitas here. And I realized that the reason they needed help was they didn't have the right system. And it gave me the idea that since they're still making a living out of it, and I knew how to put the right system in place, that I'd start my own company, which I did in '89.
I see, okay. So why would someone consider the alternative of using a self-directed IRA rather than a conventional IRA?
Well, the fundamental reason is that 2/3 of an individual's net worth in the United States, as determined by the Department of Labor a number of years ago, are in the kind of assets that you can access or invest in through a self-directed IRA that you can otherwise not invest in a typical broker-dealer or traditional bank. Namely, private business. I mean, whether it's the pizza parlor on the corner or the dry cleaner, the country has got, everybody knows that small business is the backbone of this country. And so you can invest in those kind of businesses through a self-directed IRA, whereas you cannot generally through a traditional broker or bank. And similarly, real estate, which is the largest asset that most Americans have in their net worth, is something you cannot invest in through most typical providers. They provide investments that they get compensated for, which are typically mutual funds and stocks and not real estate.
Okay. What types of retirement plans does a company like Pensco handle?
The full gamut of the IRAs, every type of IRA, from a simple IRA to a SEP to a Roth, a traditional IRA. We also handle solo 401ks, which are 401ks just like a traditional 401k, but there's only a maximum of two participants, which would have to be a man and a wife or just one or the other.
Or now I guess we could say married persons.
Yeah, married persons, yeah, right. Beyond, you can't have any other employees to have a solo K, but we handle all those. Most of the other providers that are in our Retirement Industry Trust Association also provide the same services.
Okay. So what kinds of unusual investments besides real estate have you been seeing held in IRAs and Roth accounts?
Well, I've seen, the full gamut. I mean, I left Pensco a number of years ago, but I was there for 22 years, and in that, doing thousands of transactions, I've seen all kinds of things. But the one that always sticks out in my mind, which I think is the most creative thing I've ever seen, was I got a call from a woman in Alaska saying, I'm a fisherwoman, my husband's a fisherman, we're out on a boat 10 hours a day for the last 20 years, we don't own a computer, I don't understand the stock market, but I have an opportunity to buy the fishing rights for black cod up in Alaska in a certain part of the ocean. There's a map in the ocean, I can lease that from the state of Alaska. And I said, okay, and then what? And she said, well, I'm going to sublease it to day fishermen for a markup. And then have that go back into my IRA. I'm going to buy the lease with the IRA. And she said, can I do that? I said, well, based on what you represented so far, yes, you can, but I'd like to see the lease agreement. And the bottom line is she did, and it was written up in Fortune magazine a number of years ago.
Yeah. So it's sort of depends on your imagination to some degree.
Excuse me, it was Forbes magazine, I believe.
Okay,
yeah.
Forbes, thank you. So we said before, real estate is popular.
Absolutely.
And
but private stock is another thing. I mean, all of the providers have, we're proud in our industry of the fact that we've helped start thousands of firms in the United States. As we all know, trying to get capital for a startup is very difficult. You can't go walking into your bank and say, look, I got a great idea for a new hot dog stand. Can you give me a loan? They're not going to do it. Mm-hmm. Or for that matter, the next Apple, they're still not going to do it. So you either have to go to venture capitalists or angel investors, or you can use your own IRA. Mm-hmm. And a lot of people have, like you said earlier, a lot of their wealth is tied up in their retirement account. And if they, maybe have accumulated some for a while in a 401k with a traditional provider, and then they leave that company for whatever reason, and they have this bright idea, they can either fund their own idea or they can fund somebody else's idea. And now there's something called crowdfunding, and for small denominations, you can participate in any number of these startups. Mm-hmm. And a lot of the legwork is done for you. The due diligence is done by the portals, and then the custodians. Pensco, I think, is hooked up with like 7 or 8 of these portals. So if you wanted to take a small amount of your money and instead of, first of all, you never want to put all your money into one basket, whatever it is, whether it's real estate, the stock market, or whatever. But you could diversify. You could take, let's say, 10% of your portfolio and put it into private equity, and maybe put it into 5 different companies if you wanted to hedge your bet. But it's much more facile. And I would point out, though, right now it's restricted to accredited investors only. You have to be an accredited investor, which is a net worth of $1 million and $200,000 annual salary for the last 2 years, kind of thing, exclusive of your private home. But the law originally passed by Congress allowed people with less than that to be able to participate, but the SEC hasn't written the rules for that. They're dragging their feet. They don't want that to happen. Okay. But in any case, it was designed to allow other people, to participate.
How about private money mortgages?
Sure. You can either invest directly in like, say, an unsecured note or a secured note, which are typically, instead of the bank loaning somebody money to buy a piece of real estate, your IRA is loaning them and acting as the bank. And in those cases, you want to make sure you go through a title company, get a secured. I mean, you want to make sure that the security is in place, that the deed is in place and it's recorded. And then if there was a failure to pay back the loan, then you would foreclose on the property and get the property under the law.
Mm-hmm.
So it's very important that they get executed properly, and the custodians that do these things are aware of the rules and will help you along the way. And again, there's a lot of education available.
Good, okay. So what kinds of co-investments are possible for a business?
Well, typically, when you want to start a company, because of rules that are much too complicated to explain today with the time we have, you can't just, let's say, take your IRA, buy a company, take a salary, and just run it by yourself. I don't want to, get into elaborate on the details, but that would be a problem. But if you co-invest with either other family members or just friends, associates, or whatever, and bring in outside investors that you may not have known up to that point, there's no limit as to what the percentages are. However, the timing of how you do it is important. So, for example, if your son starts a business and he's the only owner at the time, and he asks you to invest with your IRA, since he's 100% owner of an entity, that entity becomes a disqualified person, which is a technical term, but basically says you can't self-deal with your direct relatives, your parents, your grandparents, your children, the spouses of your children. Ironically, technically, you can invest with your brothers and sisters, and it's not a problem. But you got to still do it carefully. Mm-hmm. And again, there's a lot of education, and maybe it's a good time to mention this book. This is a book called The Self-Directed IRA Handbook by a friend of mine, Matt Sorensen. It's available on Amazon. It's really inexpensive. It's quite elaborate, and you can find your particular interest in the table of contents. And Matt is an expert in this area. He's also on the faculty of the Retirement Industry Trust Association Institute, which I am as well. And it's open to the public, that institute. We have a class coming up in May, but nevertheless, this book is a really good resource. And another book that's an excellent resource is another friend of mine, Matt Allen, and it's called Leverage Your IRA in Real Estate. So we talked about this in another session, but this also goes into, I've written 2 chapters in here on prohibited transactions, which sort of touch on what not to do when you're co-investing.
Right. So maybe we should go back for just a moment, though, because you sort of brought it up. So a prohibited transaction. Well, first of all, what's the consequence of when you have a prohibited transaction?
Well, if the IRS discovers it, generally through an audit, and it may be an audit that's instigated by a normal tax audit, but when they start looking into all your records, whatever, and they find out you have an IRA, they might go into that. And particularly now that they're sort of focused on alternative assets after they realized that Mitt Romney made a lot of money in it, that they might start auditing you. But the consequence is, if they find that 2 years ago you did something that would constitute a prohibited transaction, they will go back and say that your IRA was disqualified as a retirement account 2 years ago, and you will be subject to taxes from the distribution of all the assets in that retirement account, plus penalties and interest on top of that from that time forward, just like there would be on your 1040. So you lose your retirement account entirely. It becomes a tax. You get the net proceeds after all the taxes and penalties, but that's not something you want to do.
Yeah, it's a big hit.
Yeah.
Yeah. So an example, though, then the IRS had made a rule. Actually, I think there was a court case, wasn't there, on this business of a salary? I think it was the tax court
There's
memorandum.
Ellis versus the commissioner, and there's another one called Peak versus the commissioner. In one case, a fellow started a used car business and paid himself a salary, which again, under certain circumstances you can do. But In his case, he hadn't even started to generate income. And so when he was paying himself a salary from funds that came from his retirement account, he was basically taking an unauthorized distribution. So, if he had diversified and had other owners in there and he waited till the company started generating income and he didn't get any special treatment other than anybody else, he probably could have done that all right. In the other case, the I think it was Peak versus Commissioner, that individual basically invested in an entity, and then that entity guaranteed a loan for another entity. And since the first entity was funded entirely by his IRA, by guaranteeing a loan for that entity, he created a prohibited transaction, because you can't self-deal with your entities.
Yeah. So you have to be real careful with this stuff. Like I said, this is why it's not a do-it-yourself project. Okay. This is a question I get a lot. Can stock acquired using an employee stock option be held in an IRA or a Roth?
Not unless it was initially issued to the IRA. If you own it personally or granted it personally, excuse me, I have a bad cold today.
It's okay.
If you're an employee in some, startup company, whatever, and then you get issued stock options, and then at the same time you might have an old IRA or a 401k that you rolled to an IRA and is sitting on the sideline, and then later on you want to exercise these stock options, but you want to do it with your IRA, so all that stock would go into your IRA. You can't do that because that's an asset that you receive personally. Even though it was an unexercised option, it's a right that you have personally that you can't assign to your IRA nor transfer to your IRA or acquire by your IRA, because you're now dealing with yourself. That's called self-dealing. Right. I've been asked that question probably 100 times in my career, and it's always the same answer.
Yeah. Also, the other thing is, I think you and I talked about this before, but the only thing you can really contribute to your IRA is cash, isn't that right?
Exactly.
Yeah.
Unless you're rolling it out of a pension plan.
Yeah,
in which
unless
case,
you're doing a rollover. Yeah.
Yeah, you can take anything then.
Okay. Okay, about 10 minutes left. So maybe you can give us some examples of some outstanding successes of investing in alternative investments using an IRA or Roth. And we have to say your experience will definitely vary.
Yes. Well, I can't name names because, banks have rules about privacy.
Of course.
But I can say that Pensco is very proud to have helped a number of entrepreneurs, because of our proximity to Silicon Valley, to start numerous companies. And probably the most successful was an individual who took about $1,800, which they were going to put into, this is back in 1999, they were going to put into a traditional IRA, and the limit back then was $2,000.
Right.
And I said, well, why don't you use this new Roth IRA, and if you think this company is going to be really successful, you'll have tax-free growth. So that's what the individual did, and 3 years later, that individual sold the company for $34 million.
Wow.
Actually, 2.5 years later. And it's a very famous company everybody would know, but I don't want to release that. But then he took that money and used it to start other companies. And it's funny, this morning I read about one of those companies that's now just raised another $400 million, and it's going to be quite successful, I believe. But in any case, one of those other companies that he invested in was a social media site that everybody is very familiar with. And it turned out that his original investment ended up in the hundreds of millions of dollars from $1,800.
All in a Roth account.
All in a Roth IRA. But fortunately for us, and probably for him too, he turned a number of his friends onto us, and we've done similar things with others, which has led to our growth. We're now, like I said, $10.5 billion. Mm-hmm. But this is to prove that you can take $1,800, and if you, instead of taking your entire, retirement account, and if you know what you're doing, and you get in on the ground floor.
Well, you have some luck.
Yeah, you have some luck. Well, first of all, I always try to caveat, because when I got my BA in economics, my thesis was the likely success of business startups, and 1 in 7 back then, of course it's not changed much, 1 in 7 firms make it to their 5th anniversary.
Mm-hmm.
So that's pretty high. I mean, not really good odds for a retirement account.
Mm-hmm.
So 1, you don't want to put a lot of money into it. 2, you have to be prepared for either a real big gain or a total loss, because when the companies fail, you don't get anything back.
Right. Okay. So we talked a little bit about this in our previous interview, but I want to address it again because in some ways I think it's even more important when we talk about alternative investments, because the problems can be more difficult, and that has to do with the business of annual valuation reporting requirements. So maybe you could talk a little bit about that for a few minutes.
Well, although there are a lot of public policies and procedures coming from regulatory agencies designed to attempt to perfect the process of valuing alternative assets, in many cases it's not totally realistic or nor cost beneficial. Mm-hmm. And that while they won't admit to that is the agencies, they raise the bar or throw the standard out there that, well, the standard is you gotta fully value every asset, just like you would on a stock market trade. But the reality is, because we've met with them, that is the REIT organization, there's a recognition that if you're in the first year of Apple Computer and you don't even have a prototype built yet, there's no one in the face of the earth that could estimate accurately what the value of any investment would be at that time. That's just the fact. And if you required that kind of accuracy, first of all, you could never achieve it. You would pay a lot of money to attempt to achieve it. That is, to a firm that would do that, maybe $40,000. And if you got a $10,000 investment, you don't want to invest $40,000.
Right.
But nevertheless, the result wouldn't be perfected. So, and it's funny you mention that, because I once spoke at a panel down here in, I think it was Palo Alto, on private equity, and when I got done speaking, there was another panel with a whole bunch of valuation companies, and I asked them that question. If you had an investor come to you and said, look, I just met this guy, Steve Jobs and Steve Wozniak, in their garage, and they want me to put in $50,000 into their new investment, but they don't have it yet. I mean, they don't have the product yet. Can you value it for me? I said, what would you say? And would you agree that none of you would have the same answer? And they all agreed. I mean, it would be impossible.
Yeah. Yeah. But nonetheless, so there is a requirement.
Yeah. Nonetheless, the IRS says to custodians and banks and broker-dealers that we want you to provide annually the fair market value of every investment, including alternative investments. Now, responsibility for obtaining that is not on the bank or the custodian. It's their responsibility is to report it. Mm-hmm. But responsibility is for either the asset sponsor or the client to obtain it from the asset sponsor, or the client to obtain it from an appraiser or a CPA to do that evaluation, which would be paid for by their IRA. But we are responsible to try to track that down, pull it in, and report it on an annual basis. Beginning this year,
2015.
Yeah,
okay.
They're focusing on. Actually, the IRS is requiring custodians to report specifically the amount of various types of alternative assets held in each IRA on the 5498.
Right.
So if you're investing in an LLC or real estate or private equity, that's going to be identified on 5498. Because what they want to do is they want to look for any assets that may be undervalued, because ultimately they want to get the tax in the IRS for the true value.
All right. And so, of course, what happens, I mean, this isn't so critical for the account owner in some ways until they reach 70 and a half.
Or no, if they're doing a Roth conversion, for example.
Or if they were doing a Roth conversion, excuse me. So if you have a taxable transaction of some type, so a Roth conversion is a taxable transaction.
Or you're taking a partial distribution.
Okay. If you were taking a distribution of property.
Yeah, of the asset, whatever.
Okay,
that
so
may be.
maybe I was oversimplifying, excuse me. Once the person reaches 70 and a half.
That's why you had me here.
Once the person reaches 70 and a half, then they have the required minimum distributions each year that
Right.
need to be taken.
Right.
That's computed based on the fair market value of the account. It's divided
Right.
by life expectancy.
Yeah.
And
Well, with today's deficit, the IRS is looking for immediate hits,
Oh,
and
yeah.
they're looking for low-hanging fruit. And once they found out about how much money Mitt Romney made, they investigated the hell out of him and didn't find anything. But they're looking for more cases.
yes. So they are looking more at retirement accounts maybe than they have in the past. Definitely, again, this has been an issue that's been sitting around for many, many years that we've known. I call it an elephant in the room. But now it's come a little bit to the forefront. And
That's because
and-
I'll have to say that's because self-directed IRAs have been so successful. In fact, IRAs have been so successful. There's more money now in IRA accounts than all the pension plans combined.
Right. Okay. Well, actually, I think we're probably just about out of time. There we go. I got about a minute. So I'm just going to wind this thing up and say, be aware there will be more expense involved, I think, in being an account owner and having these alternative investments. You need to be aware of that when you're doing it. On the other hand, you don't want to blow yourself out of the opportunity of investing $1,800 and turning it into $30 million. So we're all out of time, folks. Hope we've given you some things to think about and to follow up on. We'll see you next time on Financial Insider Weekly.